Yeah. So Lynn, if this backlog of products are just sitting off on the coast, and obviously we know that rent and auto sales are huge into the CPI numbers, are we looking at inflation running hot for months on end going forward?
Yeah, I still see inflation being pretty high prints, at least for the next quarter and probably the next 2 quarters. The further we look out, the murkier that gets. And so I think a lot of that comes from just the housing component, or the owner's equivalent rent and the rent prices. And then, yeah, basically all these other factors add on to it as well. And so my base case is that I've not been trying to say predict what the exact number is going to be, but basically I think this elevated range is going to be in here for at least another 3 to 6 months. But then the further out we look, we have to update our information as we go along. We have to see what happens with the supply chains. We have to see what happens with stimulus or not. But I do think that the first half of 2022, or at least the first third of 2022, still does look pretty hot in terms of at least the inflation metrics I'm looking at.
Gotcha. Eric, are you in agreement? Inflation running hot as we move?
Yeah, I think that the way that I look at it, a lot of people focus on the rent component because it's 30% of the basket. And we do know with some degree of certainty that that's going to continue to rise because of the lead with home prices. But, and this is Jay's domain, but durable goods, which includes the used cars, is 10 or 11% of the basket. But the volatility of the durable goods component is way higher than the rent component. So if you normalize every factor for its weighting and volatility, it's the durable goods that are the most important factor in the increase in inflation that we've been seeing. So where inflation goes from here is going to be largely dependent on the durable goods component, which is going to be basically entirely driven by the factors that Jay is talking about. The other point that I want to mention is that it doesn't really do us that good, or it's not that helpful to forecast the inflation number for the sake of the inflation number. We need to forecast the inflation number as far as what it means for asset prices. And the most sensitive asset to inflation generally is treasury bonds. But we've been seeing an interesting dynamic, which Lynn mentioned in the open of the show, which is that even though inflation has continued to rise, long-term treasury rates have been coming down. And the reason for that is because, as Lynn mentioned also, this isn't a traditional money price wage spiral type of inflation that we would see in a economy that's driven by lending growth. We're seeing a supply side inflation where the supply curve is shifting inward and it's cutting the demand curve at a higher price, but a lower level of real growth. So the treasury bond market is responding to that lower real growth. And then you throw on the other factor that Lynn mentioned, which is that the Fed is going to tighten into this. And there's no real indication that raising the Fed funds rate to 3% is going to make a ship come in from the port. So all you're going to do is further damage real growth. And you're going to be in a situation where inflation perhaps stays high, but real growth continues to trend down, down, down until you get to the point where growth starts to oscillate around the zero bound. We're not quite there yet, and we're not going to be there in Q4 because of more inventory builds. But that's the dynamic that's playing out in the treasury space, which is inflation is still running hot, but this is not traditional inflation. This is very much supply side driven inflation, which is driving real growth lower. The other point to make is that we had a recession, and inflation generally bottoms 2 to 4 years after the recession. So we had a recession in 2009, inflation bottomed around 2012. This recession, because of the dynamics, inflation spiked very early on, which damages real income. We've seen a decline in real income, which is going to prevent the economy from catching escape velocity, and it's going to prevent the Fed from executing this tightening process.